All right, when a big bank like US Bank drops its quarterly earnings, it's easy to get lost in a sea of numbers. But today, we're going to cut through all that noise and get to the real story behind their pretty impressive results. It all really starts with this one number, $1.22. This was the single figure that got everyone talking after US Bank's third quarter announcement. So what is it? That's their profit for every single share of the company. And it's up a whopping 18.4% from this exact same time last year. Now, in the world of big banking, believe me, that kind of growth is a very, very big deal. So, the big question is, how'd they do it? And more importantly, what does a number like this really tell us about the health and the strategy of one of America's biggest banks? Let's find out. Well, the short version is this was just a powerhouse quarter for them. We're talking strong growth, a major boost in productivity, and some seriously smart financial management all coming together at the same time. To really get what's going on, we first have to pop the hood and look at how a bank like this actually makes its money. It really boils down to two main engines: the interest they earn and the fees they collect. And this chart right here really tells the story. Sure, interest from loans is the bigger piece of the pie, but look at that. A huge 42% of their revenue comes from fees. Now, this is so important because in a world where interest rates can be all over the place, having a diversified income stream like this, well, it makes you a much more resilient and stable business. And that fee income isn't just stable, it's growing, and growing fast. This isn't some one-time fluke. We're looking at a consistent upward trend that resulted in a 9.5% jump this quarter compared to last year. That's some serious momentum. Now, here's the really cool part. Look at where that growth is coming from. It's not just one area carrying the whole team. They're seeing strong performance pretty much everywhere, from managing money for big corporations to handling investments and credit cards. That's the sign of a really healthy, well-rounded company. So let's dig a little deeper. US Bank is making some very targeted bets to power all this growth, and we're going to shine a spotlight on three of the most important ones. First up, their giant payments division. I mean, think about it. Every time a customer swipes a US Bank credit card or a small business uses their system to process a sale, this engine is just humming in the background. It's a core part of their strategy, and they're pouring resources into it. Next up, they're doubling down on their consumer bank. You know, that's Main Street banking for you and me. And they're doing it by opening new branches, using data to offer products people actually want, and really focusing on building deeper, long-term relationships with their customers. And then there's this, which is something you don't see every day from a big bank. It's a fast-growing division they call Impact Finance. This group actually focuses on financing things like affordable housing and green energy projects. And get this, it's not just a feel-good story. It's a fantastic business with revenues showing a 17% compound annual growth rate. Wow. Okay, so they're clearly really good at making money. Check. But that's only half the story. The other half is about how good they are at saving it. And that brings us to operational efficiency. The key metric to look at here is something called the efficiency ratio. Let me break it down in simple terms. For every single dollar in revenue US Bank earned this quarter, it only cost them 57.2 cents to make it. And in banking, a lower score is always, always better. And they are definitely getting better over time. I mean, just look at this trend. A year ago, that ratio was over 60%. This clear downward line is exactly what investors want to see. It means they're getting smarter and leaner about their spending. All of this leads to what people in finance call the holy grail: positive operating leverage. It sounds fancy, but the concept is super simple. It just means your income is growing a whole lot faster than your costs are, and that is the ultimate sign of a healthy, scalable business. So what was their number for the quarter? An incredible 530 basis points. Now, don't let the jargon scare you. A basis point is just 1/100%. So all this means is that the revenue grew 5.3 percentage points faster than their expenses. That's a huge gap. And that number isn't just good, it's fantastic. Their own internal goal was to hit over 200 basis points. They didn't just beat it, they absolutely crushed it. We're talking more than double. This is a masterclass in just getting things done. So the quarter was clearly a massive success. But what does the road ahead actually look like? Well, let's check out their performance against their own long-term goals. Think of this table as the bank's report card.
And honestly, they're getting straight A's. Their return on equity, hitting that high teens target. Their fee growth of 9.5%, that is blowing past their goal of mid-single digits. And their efficiency ratio, it's right in that sweet spot they were aiming for.
And that last one, the CET1 capital ratio, is especially important. You can think of it as the bank's financial safety cushion. It's like their emergency fund. It's a measure of how well they could handle a major crisis, and a higher number means more stability. So looking ahead, the bank is pretty confident this momentum is going to continue. Their own forecast for the next quarter is for more of the same, stable income and even more growth in those all-important fees. This clearly wasn't a lucky quarter, it was all part of the plan. Which really leaves us with one final thought. We've seen these powerful, diverse growth engines combined with aggressive, smart cost control. It really raises the question, are we watching US Bank write the new playbook for success in modern banking?